Hey, what's going on, everybody?
Hey, what's going on, Michael? How you doing?
I'm good. I'm good. Hey, how about yourself?
I'm doing all right. Let me people start to trickle in at the exact. Let me bring my screen on so it's not just you talking. How's it going?
Good, good. You still out in Vegas?
Yeah, I just man, so I just got up. I just got back out to Vegas on when did I get here? On like the first. So I've been back in Vegas for about a week, and man, it's been nonstop since I've been back. So you know how that
Right
goes.
on.
Yeah, it's been nonstop. How
Well,
about you? How you doing?
I'm good. I'm good. We were up in the out in the Grand Canyon the last couple days, and now we're down in Phoenix, and it is just so hot down here as compared to up in the mountains. So it's taking
Yeah.
taking a toll on us for sure, but it's been great.
Oh man, yeah, I seen you had just posted a picture that you guys were up in the looked like the canyons or something like that.
Yeah, the Grand Canyon was incredible. I'd never been before, and so my wife and I were like, "Yeah, let's go out of our way and check it out," because we were coming down from Southwest Colorado, so it
Uh,
was more or less on the way. So it
yeah,
was
I do like
awesome.
Colorado. I feel like Denver is probably like one of the most hidden cities in my opinion. I love Denver, and a lot of people don't really know how good Colorado and Denver is because they just think of the snow, right? But the summer's
Right.
actually pretty nice out there. And then, like I said, if you're into the mountains and skiing, and definitely like Colorado is the place to be in the wintertime for sure.
If I wasn't married to the ocean, I would have been in Colorado 15 years ago. I
Yeah.
mean, I love it out there. And I feel
Uh-huh.
like most people who go, it's like Hawaii. It's one of those places where people go and you say,
Right.
"How was it?" And everyone's like, "It was amazing." No one comes back and goes, "It was okay."
Right. Yeah, I've never not had a bad time out there. And actually the last time I went out there, I got to go experience one of the hot springs that they have out there. That's about an hour and a half, probably west of downtown Denver, I would say. They
Okay.
got natural hot springs out there, and it's pretty cool because I'm thinking it's going to be like an outdoor type of hot springs, but it was in like a dome type of thing. So they had the water, I guess, coming down from the mountains, and then you're in like this dome this dome type of atmosphere. So it's like you can look up and you're not seeing the sky because you're kind of like in this dome type area.
Oh,
But it was,
wow.
yeah, it was something different. It was unique. And it was a pretty fun experience.
That's awesome. My wife and I realized that we are now semi self-proclaimed hot spring hoppers.
Yeah,
So this whole trip we've been stopping at hot springs, and Colorado has a lot of really great ones.
yeah, they do. I used to stay out in Idaho, and man, they got a lot of hot springs out there. So I used to bounce around to them all the time.
I've
I'm
heard
from
tons of
Washington.
people. Yeah.
Yeah, I'm from Washington. We got a few out there, but we don't really have, not like the Idahos and the Colorados and Montana and Wyoming. Like once you start hitting that region, then you got hot springs left and right out there.
You get spoiled quickly.
Yeah, for sure. So yeah, we'll give everyone about another minute for people. Sometimes people come in right on. I know we got a few people on here early. Um, but yeah, so yeah, thanks, for coming on with us. Really appreciate you taking the time out of your day to sit down and talk with our members.
Thanks for
Uh,
having me.
yeah, I've been, following you, looking at you, and it's like, the thing about us is what we try to do is we try to bring on a lot of positivity, right? We like having positive people on. You talk about your story a lot, being remote, traveling the world, right? That's something I can definitely relate to a lot. That's actually something that drove me to you before the real estate side of things because I seen that you were always traveling, right? I seen, you have your RV,
Yeah.
the background. So it's like I love that. I love people doing what they feel is their calling, right? What makes them happy. Everyone's happiness is going to look different, right? And I love that you promote handling business so you can be able to do what you want to do, right? And that's what I try to tell people is like so many people have this mindset that if you do what you want, that means that you're not going to work, right? That's not the case. It doesn't feel like work when you enjoy what you're doing. So that's why it's always best to find something that you enjoy doing and try multiple things until you find that thing. And then you can do exactly like you do. You get to travel around and you're still handling business in the process of doing that. So that's kind of one of the things that drove me to you.
Oh,
Uh,
right on. Thanks for that.
that I can remember because I'm a travel guy. I actually started, my Twitter and all that stuff, like I was telling you, just because, it's just basing it around travel. I didn't even
Right.
think people would even care about all the other stuff that I do. I just kind of wanted to get on there and start talking about travel. And then it just kind of led me to a bunch of other cool people in the process. So definitely, like I said, appreciate you coming on here. Appreciate you, getting ready to share, your wisdom that you have and things like that. So without further ado, let me just go ahead. I have a slide here I'm gonna go ahead and bring this up just so I can introduce you. All right, so for those of you guys just tapping in, some of our past agendas, like I said, we've covered a lot so far. All these classes are recorded. This class that we're going to have with Michael is going to be recorded, so you guys will have access to go back if you guys have to, get out for whatever reason. But for those of you that are new to this class, all these previous classes are all uploaded. All the benefits to real estate, how to find property managers, how to find mortgage lenders, first time home buyer programs, how to run your numbers, all that stuff, breaking down properties, conventional loans, VA loans, REITs, all that good stuff. And today we have a guest. We have Michael on here. He's gonna drop some gems for you guys and talk about his real estate journey and the mindset that it takes to become to get into real estate, right? Because it does take a mindset shift. And I'm glad he's actually coming on and talking about this, so you guys can get a different perspective, right? He's 10 years as an investor. Some of the keynote specialized value add and commercial multifamilies. He used to work as a professional forest protection engineer in the commercial property insurance industry. And he quit the corporate world in 2019, and he's been traveling around freelancing. So if you guys go check him out on Twitter, you guys can see he's a big advocate for traveling around. I have his @ right there. And he's actually a co-host for a podcast, The Remote Real Estate Investor, which is pretty cool. You guys got about 100 episodes that you guys have now?
I think we're almost up at 200, believe it
Okay,
or
so
not.
yeah, so all right, 200 episodes of that. I dropped the link down below, and then let me go ahead. Like I said, so he's gonna get on, you guys. He's gonna do some talking, give what he gives to you guys, and at the end, we'll open it up to a Q&A. If you guys have any questions, you guys can type them in the message, or you guys can talk out loud once he gets done. So I'm gonna go ahead and hand it over to you, Michael. Do your thing.
Awesome. Thanks so much, Ace. Well, really appreciate you having me on, and thanks everyone for hanging out with me for hour and a half here. And it looks like you had some really great other classes. So I hope this will be as exciting as some of those other ones. So I'm going to bring up my screen here if that's okay.
Yep.
And let's see. Ace, I think you have to make me the host or allow me to share.
All right, let me get out of here real quick.
And like Ace was mentioning, I've got some time set aside at the end of today's session for Q&A, but the way I like to teach is very conversationally, because otherwise it's just me talking at the screen or talking at all of you. So if you have a question, you have a comment, you have something that you're just dying to ask, go ahead and chat it in the message section, and that will just talk about it kind of on the fly. And so I'm going to pull up the chat section so I can monitor it here as we go along. So I'm going to get set up here. All right, so basically what I wanted to talk to everybody today about is the new investor mindset, how to go from 0 to 1. And if you're someone that already has a couple deals under your belt, this is something that can still be applicable to you, because I think that there's still a pretty big mindset shift that has to happen to go from 1 to 4 and 4 to 10. And I don't know if anybody knows Michael Zuber, the name out there. So he's an author, he's a big advocate of real estate investing, he's a California guy like me. And so he talks about just get 4. Once you get 4, then you can get to 10, then you can get to 20 and 50, whatever your number looks like, but just get to 4. And he wrote a book called One Rental at a Time, which is a really great book. I'm a big fan, big advocate. And so if you're someone that's figuring out, okay, I figured out the 1, now how do I take steps 2, 3, 4, 5, 6? Check out that book. I think it's really helpful for a lot of people. So a quick introduction about myself, and thank you, Ace, for the warm introduction. So I've 10 plus years real estate investor. I was nearly a decade as a professional fire protection engineer in the commercial property insurance world. And I didn't know what that was until I got in the industry. And basically, we tried to make sure that buildings don't burn down. And if they did burn down, how do we get that business back up and running as soon as possible? And then also, how do we mitigate and engineer against natural hazard risks or risks like within the building itself? So a lot of fun. That was my past life. But I realized pretty early on that I wasn't getting where I wanted to go fast enough. And so I'm also the head coach with the Roofstock Academy. And then I personally have experience purchasing single family homes, condos, multifamily value add, commercial, double net, triple net lease properties.
You
So
talk too fast.
I'll try to slow it down. I've got a lot to say, so I wanted to make sure we get it in, but thank you for letting me know. So I started my real estate investing journey about 10 years ago, purchasing a single family home in Southern California in a market that I was relatively familiar with. I'm an LA guy by birth, and so I knew this area. I'd grown up there going on vacation. and I purchased my first single family rental. And I said, if I can do this one time, once per year for 10 years, I'll have 10 rentals. And that sounds like a good number. So that's what I was shooting for. And I had done that a couple times. I had did that in year 2 and year 3. But at the same time, I was traveling all over the Northwest US for work because I was working for a global company. And what I started to realize is that the numbers outside of California made a heck of a lot more sense than in California. The price points to purchase were a lot lower, and the rents were sometimes even higher than what we would be seeing in California. But there was this ratio, and some of you may have heard about it on previous classes. You might be familiar with it, that price to rent ratio. And a lot of you may have heard of something called the 1% rule. And the 1% rule simply says if something rents monthly for about 1% of what you can buy the property for, it will probably cash flow even with a mortgage. And so the best example of that kind of tried and true is something you can buy for 100 grand should rent for about $1,000 a month. And so we do that 1%. We move the decimal points over 2 places from our purchase price to get down to that 1% rental. So that's our $1,000 a month. And I was finding these types of properties outside of California. And so that's really when I started investing in small multifamily. And for those who might not be familiar, multifamily is simply more than one unit. And residential multifamily, we consider 2 to 4 units. So if you hear someone talking about small multifamily, they're typically talking about residential, which is that 2 to 4 units. Single family is, of course, that 1 unit. Commercial is 5 units and greater. So I started dabbling with small multifamily outside of California because I just happened to be traveling there. And I was running the numbers incorrectly, but as close to as accurate as I knew I could be at the time, because I just didn't know a whole lot. Bigger Pockets wasn't around, it wasn't on Twitter, Roofstock wasn't around. So these companies that really help educate people just didn't exist. So I kind of muddled through it myself. So I was investing in small multifamily, and I thought I was just a freaking genius. I thought I had got this real estate investing thing dialed, thought I had it figured out. But I got to a point where I was like in 5 or 6 different markets in different states, and it just got to be too cumbersome because talking to 6 different property managers about 6 different properties was just mentally and physically pretty exhausting. So I got some advice from someone that was a lot further along in their real estate career than me and says, Michael, you're doing it all wrong. He told me, go get laser focused, go hammer one particular market and go deep there as opposed to going wide and multiple, and watch what happens. It'll blow your mind. And I said, okay, I mean, that's kind of counterintuitive to everything I thought I knew about investing, because anyone who's read books about investing or the stock market, a lot of things tell you to diversify. Well, if anyone else has read Rich Dad, Poor Dad by Robert Kiyosaki, he tells you forget diversification. He says, go get focus, go do something really well and be the best at it. And you don't need to diversify. And I was like, okay, that's kind of different, but I'll give that a try. So I got hyper focused, I got hyper vigilant about one particular market, and I started hammering multifamily, commercial multifamily properties. So that's 5 units and plus that needed work. Because up until that point, I had always bought things that were relatively turnkey. I wanted to go in, buy the thing, and have it cash flow day one. Well, that was easy. I figured out how to do that. I had done it enough times to be fairly proficient at it. But I wanted an edge. I wanted to add value so that day one, I was walking into equity as opposed to paying fair retail market value for a property. So that's what I started doing on a particular market, hammering away. And that's what I've been doing the last couple of years. And it's been really amazing to watch the growth that I've been able to see over that time period. And that's mostly due to the fact that I've been building out a team. Because anytime you spend a lot of time in a particular area, you're going to develop relationships, develop a network, for better or for worse, semi-organically. And so that's really what's happened for me over the last couple of years. And like Ace mentioned, in 2019, I left my corporate job and I was traveling internationally for the better part of that time with my wife. And then COVID hit, so we came back to the US and then converted a van. And so we've been traveling in that for about the last 6-7 months. And that's actually where I'm recording, speaking to all of you right now. I'm in my van in Phoenix, Arizona, and just loving that life. And so today I own 60 doors across 8 markets. So this was my first property purchase. As you can see, I mean, these are like the listing photos. It is about as turnkey vanilla as it gets. Nice house, newer build. Just you literally turn the key, and some of you may be familiar with that term. You turn the key, you walk in the door, and it's ready to rock and roll day one. This was my most recent purchase. Some of you might not even be able to tell what a lot of this is, but on the left here, we have a fire damaged unit. And then this is beat up pretty good, damaged bathtub, damaged exterior. I mean, this is the kind of stuff that I look for. And so I've really come full swing 180 degrees across the spectrum from about as turnkey as they come, not needing any work, to the dirtier, the grimier, the smellier, the more beaten up, the better. And that's taken a lot of experience and a lot of mindset shift too, to recognize, okay, well, what is value? And value means different things to different people. And if you take nothing else away from today's conversation, I want it to be this: that what makes a great investment property for Maiku might be very different than uh, Ronaldo, or for Ace, or for myself. And so it's a very personal judgment call, because we're all coming to the table with different sets of circumstances. And so this is the agenda that I want to talk about today. So we got through the intro. So now we're going to be talking about where are you starting from. We'll talk about how knowledge is power. We're going to talk through some pro tips. I'm going to share some personal info with you all, and then we'll have time for Q&A. But if you're just joining us, this is recorded, like Ace mentioned. And then if you do have questions, please send them in the chat section. So that way we can just kind of have a conversation. That's really how I like to teach. It's a lot more fun that way when you're engaged and I'm engaged, and we can talk about things live. So let's start by talking about, where are you starting from? And so knowing where you're starting from and where you're trying to go is hyper critical. If you're going to be starting your real estate investing journey, or if you're going to be starting your journey investing in anything for that matter, I would argue. And so also knowing if real estate is even the right vehicle for you is also hypercritical, because it's definitely not for everyone. Now, I'm someone that kind of says real estate is for everyone, but I would definitely say that there are certain types of people that real estate is just not going to be a good fit for. And so if you're someone that likes the stock market because you believe in the stock market, and I'm going to have to fight you every step of the way to convince you why real estate investing is a great asset class or a great vehicle for you, it might not be. And so rather than us butt heads, you can go do your stock market thing and have a great time, and I can go do my real estate thing and have a great time. And so it doesn't have to be for everyone. I'm of the mindset that I think it's a great asset class and a great vehicle for everyone, but I'm not in the business of convincing people why they should invest there. So again, thinking about where you're starting from, but also where you're trying to get to, is really important. And we're going to see why in just a minute. I got just a message here. No worries. So when thinking about investing in real estate, I think it's really important that you ask yourself the following questions. First and foremost, how am I feeling about investing in real estate? Some answers might include, I'm scared, fearful, hesitant, ambivalent, excited, prepared, or any combination of those. And it's important to identify, again, where are you starting from? Because we're all going to start from different levels. And what is step one for someone might be very different than someone else's step one. And so again, getting back to, it's important to remember that each of our investment, what makes an ideal investment for each of us, is going to be different. We're also starting from different points. And so understanding where you're starting from, not where Greg or Jane is starting from, but you as an individual, is again hypercritical. And then we also want to ask ourselves, why am I feeling this way? Your answers might include, because I haven't done enough research yet. Maybe it's because it's your first deal ever. And so getting at the root cause of how you're feeling, and look to understand, okay, well, how do we overcome that feeling? Or how do we reinforce that feeling if it's a positive one, but also not getting ahead of ourselves? We don't want to put the cart in front of the horse, so to speak. Let's take stock of that. Let's evaluate where we are. And then we need to ask ourselves, what would help me to feel better or more confident? Some answers might include doing more research, taking a course, talking with a coach or a mentor. Maybe nothing. I'm ready to rock and roll. I'm there. Let's do this thing. But again, taking stock of how you're feeling in this moment as you're thinking about starting your real estate investment journey, or again, applying this same methodology and mental shift to going from 1 to 4, or 4 to 10, or single family to multifamily, or multifamily to commercial triple net, double net lease properties. There's a mindset shift that has to happen here. And so really taking the moment, taking the time to evaluate, okay, how am I doing? Why am I feeling this way? How do I work through it? What do I need to be aware of? Because maybe I'm feeling too confident. So it's really important to be honest with yourself about how you're actually feeling. And it's important to be honest with yourself about what it is that you know, and also what you may not yet know. And it's the things that we don't know that tend to trip us up. And it's also important to remember that everyone starts from somewhere, and it's usually at the beginning. No one tends to be born with this innate ability to invest in real estate. Everyone has to learn at some point. And so I think, again, I can't overemphasize the point enough. It's so important to not compare, because what you and you and you and you are doing, you're starting from different places. You're likely trying to get to different places. So why would we compare our journeys and where we are along that journey? So look inward. It's a competition with yourself. It's a race against yourself. Don't worry about what other people are doing. And also be humble enough to know what you don't know. I'm someone, I've been in this business nearly a decade. I try to learn something new every day. I try to take the mindset approach that everyone has something to teach me, whether it's about life or real estate. And that way, I never am the smartest person in the room. And if you are the smartest person in the room, it might be time to find a new room, because as soon as you stop learning, I think that's when we become stagnant. And especially, and Ace, I'm sure you would agree that this is a dynamic business. Real estate is not the same from today as it was last year, as it was 2 years ago, as it was 5 years ago. I mean, the strategies I was using 5 years ago really don't apply anymore. They're not something I could go do today. And so if we stop learning, we fall behind, and that can become very dangerous. So this is a roadmap that I built to help determine where are you starting from. And you can be on any one of these steps. But the first one that I would implore everybody to get under their belt is a base level of understanding of what real estate investing is. And that could mean different things to different people. You could be someone that says, Michael, real estate investing to me is putting my money inside of a REIT. Great, that's awesome. Somebody else could say, Michael, real estate investing to me is putting money with a syndication. Awesome, that's great too. And so defining what it is for you and how you want to invest, I think, is really, really important, because as anyone who's involved in this industry knows, I mean, the scope of real estate investing is like super wide. You know, you can't see it on my screen, but it's mega, mega wide. And what most of us are going to do in our lifetime is probably a little bit more segmented. And so understanding what the options are, but also what we might be good at, or really where we want to dedicate our time and money, is really important. And so sure, we can go learn about all the scope of what real estate investing is, but we want to define what that is for us as individuals. Next, I would argue you want to set some goals, because what's the point of investing? Why are we investing? We want to define and determine our why. And that's a really common theme that you may have heard of when talking to other people about real estate investing, is you have to define your why, because that's going to drive you. It's going to pull you, and it's going to push you when things suck. And I will be the first one to promise you, if you are involved in this business long enough, things will suck. Things will be hard. Things will be stressful. Things won't go your way. But it's your why, it's your goals that's going to push you or pull you through those hard times. So getting really clear about what your goals are. And we're going to talk about what a SMART goal is, in case it's a new term for anyone. Then we want to acknowledge that real estate is the needed vehicle. If someone says to me, Michael, I'm trying to generate $1,000 a month, I've got $100,000 to play with, where should I park it? You could put that in the bond market, not lose an ounce of sleep because the real estate market isn't, it's too volatile for you. And so maybe there's a different investment vehicle that's a better fit for you based on what your risk tolerance is and what your goals are. So these are the first two steps to then get you to step 3 that says, maybe real estate's a go for me, and maybe it's not. And by the way, it's totally okay if it's not. There's no shame, there's nothing wrong with that. Tons of people have become very wealthy from doing things other than real estate. I'm a big believer in it, but I'm also very biased. Next, I would argue that you need to determine the type of property and the market and the return profile that you're looking for, because determining those 3 key things are really going to help direct you into, geographically, where do you need to go? Within that market, what kind of submarket do we need to target? And within that submarket, what type of property do we need to target? Are we okay targeting single families? Maybe we should be targeting townhomes or condos. Maybe we need to set our sights on multifamily, small, commercial. That's really going to help determine that, because it's tough to say, and we'll get to this in a minute, but I'm looking for an investment property. Cool. Doesn't do a whole lot for us. We have to get really specific around what it is we're looking for and set up parameters to help give our team, which is our next step, the tools and resources to be able to help us efficiently. So next is team building. Now, in any market, I don't care if it's remote, local, international, whatever, you've got to have a team around you. And the folks over the bigger pockets like to call it their core 4. And so that's your agent, your lender, insurance provider, property manager. I think that's your core 4. If someone knows, I think insurance might be, I might have thrown that in there. If someone knows what the core 4 is, feel free to write into the chat. But you need at least those types of representatives on your team to help you source, run, and manage these properties effectively. Now, if you're someone that's like, Michael, forget the whole remote investing thing, not for me, can't get my head around it, I'm investing locally, great. You still need an agent, and I would argue you still need a lender. You might still even want a property manager. Probably still going to need an insurance rep. So remote, local, doesn't really matter. I think these 4 critical members can really make your real estate investing journey so much easier. And I would start, by the way, talking to these people now before you have locked in something. Because as someone who's purchased a property in a new market without having a property manager in place, like that's not fun. Don't do that. So set up your team. And you'll notice that down here at step whatever 8, 9, or 10 is start making purchases. We're still back at step 5 with building our team. So if you can, do this ahead of time. And this is like a lot of work. I'm not going to sugarcoat it. I would recommend just literally calling people. Talk to people in your network that have invested in your market. Network with other people, whether that's on Bigger Pockets, on Roostock, or on Facebook groups, or just people at the coffee shop, friends, family, whatever. People who have done what it is you're looking to do in the area that you're looking to do it. Talk to them. Find out who they're using. No need to reinvent the wheel here. Now, if you don't know anyone that invests in real estate and you don't have access to Facebook and you don't want to be involved in any kind of networking group, then it's Google and cold calling. Finding out who in the area is a producer, who's getting deals done, who's getting loans originated. Talk to those people. Then we want to go secure financing. Whether that's you're using all cash, that's still financing. You still have to get it secured. And so if it's sitting in cash, great. If it's sitting in a brokerage account, great. We just want to figure out how are we going to be purchasing those properties. And if for those of us that are not using cash, we want to go to a mortgage lender or broker or officer and talk to them about what it is that they need to get us pre-qualified. And there's what's called a pre-approval and pre-qualification. You want to make sure that you're getting pre-approved, which is like a lesser of the two. It's basically you giving some basic information to the loan officer and then telling you, yep, if all your information that you told us is true, we're going to loan to you. So get that tightened up before you start making offers. Your offers become a lot more powerful. And by the way, something that I subscribe to is I don't let anyone pull my credit until I'm ready to actually pull the trigger on a mortgage. And so if someone says, oh, we need to pull your credit to get a mortgage approval, nope, on to the next one. Say, this is my credit score, this is all my information. If you can't give me a pre-approval letter, I'll go find someone who will, because there are lenders out there who can. So that's just kind of a word to the wise, because if you go get your pre-approval letter and they pull your credit and then you don't do anything for 3 months, well, you have a hard ding on your credit report for potentially no good reason. So again, that's one of the reasons I really wait to ensure that I'm ready to move on the mortgage before letting them pull my credit. Okay, we got our team, we got our financing secure. Now we're evaluating deals, like daily. I would say you should be evaluating 5 to 10 deals a day in your market, in the sub-market that you're interested in. And you should be evaluating all kinds of deals that you like, deals that you hate, deals that you are interested in, and deals that you would never buy in a million years. Because what it's going to do for you, it's going to dictate and highlight what types of deals make great investments for you. You're going to be very attracted to certain kind of things, and you're likely going to be very put off by other things. But by running the numbers, and math doesn't lie, which is the beauty of it, because our emotions oftentimes cloud our judgment, we can determine, okay, well, I thought I loved this kind of property, but the numbers are telling me actually this is where I should be playing. So it's going to help identify what makes a great deal in that market for you. And it's going to also sort out the noise, because if you go on the MLS or Zillow or Realtor.com or have an agent send you listings, there's just tons of stuff. There's tons of noise that gets in the way. And so I want each and every one of you to get online, however you're looking at deals, and just start combing the MLS, start combing Zillow and seeing what's out there, and become very familiar what makes a great deal. By the time you're ready to purchase a property, I want you to be able to tell me, hey, this property on Fifth Avenue is a great deal because it's listed at 100K, and everything in this neighborhood is going for 200 plus. You should have that level of intimacy with a submarket or a market by the time you're starting to make offers. So become a due diligence expert. For anyone who doesn't know, due diligence is basically the homework that we do on the property. And this oftentimes occurs once we get into contract or you get a property under contract. And we often have a due diligence period. And this is where we get to look under the hood of the property, see how it's been operated, look at the numbers, look at the financials of the owner or the operator, and find out, okay, were our assumptions true about the numbers we've run? How do I read an inspection report? Who do I talk to about getting inspections, right? All these things about due diligence, you should become an expert on. The one thing I hate to see is for somebody to try to get really good at due diligence in the middle of a deal, because by then it's too late. And so oftentimes newer investors want all of the answers before they make an offer. And that's just often not the case. In an ideal world, yes, get all your questions answered, then you can go make an informed offer. But this is really what the due diligence period is for getting all those questions answered. So sometimes we have to shoot first, ask questions later. And that's how I've wrapped up a ton of great deals. Is an agent brought me a deal, said, this is the price, this is the rent. I said, great, here's what we're offering. I'll figure out all the other stuff later, because making offers is free. So I want everyone to keep that in their back pocket. It's a little bit of a backwards, unorthodox way to approach situations. But in today's market, where deals are flying off the shelf within hours of getting posted, it might be something that we have to get comfortable with. Which leads me to our next step, step 9, start making numerous offers. You've come this far, now you're ready to make offers. You've done all this homework and nothing has happened. You've done all of this legwork and you have nothing to show for it. Not quite true. You've got all of this built-in real estate investing capital that is going to come to fruition. And a lot of clients I work with, I'll ask them once they close, hey, what was that like? What happened? What were you feeling? And 95% of the time they go, Michael, it was super anticlimactic. I said, of course it was, because you did everything you were supposed to do. If you've done all the prep work leading up to that point, the finish line, we'll call it, it's just signing your name. Nothing exciting happens. And that's what we want it to be. Boring is awesome. So we want to start making offers now that we're prepared and equipped to do so. And as you're starting to make offers, you're going to get feedback from your agent. You're going to get feedback in the form of winning deals and losing deals, and you just adjust accordingly. Maybe we're offering too little. Maybe for our market, that's just not going to get the deal done. So maybe we need to come up a little bit. Maybe we're being too aggressive in our terms. Maybe we need to back off a little bit. Once that happens, you're likely going to start making purchases. Excuse me just a second. You're going to start winning deals and you're going to start making purchases. And this is where really the rubber meets the road, because all these steps leading up to this point is to get you to start making a purchase. Well, now you own the thing. Oh crap, now what? Now we got to operate it. Now we got to own it and operate it. And we could do a whole nother session on what that looks like, going from purchase to scaling. But this is just getting up to this point. And so I love the analogy that I've heard in the past that real estate investing is like getting a locomotive to start moving. Steps 1 through 9, like you're not even making offers. You're not even doing anything. But once you're at 9, the momentum is going to carry you all the way through. And so it's just like getting a train moving. There's all this energy spent on just getting the train to start moving, but you don't see that. Most people only see once the train is moving. And again, that's why I think it's so difficult and so unfair to ourselves to compare. All we see is someone's success. We don't see all of the crap that they ate for the 9, 10 years, whatever it took them to get to that point. We don't see that. We just hear about the success stories. So this is the hard work that goes into getting you ready to purchase properties and then ultimately scale. And so if you're looking at this and you're like, nah, sounds way too hard, real estate investing might not be a great vehicle for you. And again, that's totally okay. So once you start making purchases, you're going to have a ton of momentum because you'll have just done all of this work. You'll have your network set up. You'll have your team in place. Now all you have to do is make a phone call. You're going to get deals sent to you, and then you can close deals very quickly. So that's the time when you want to go scale. But you also want to make sure that you're scaling the right market. So if you're someone that's like, okay, I want to buy one, see how it goes, take a step back, take a breather, totally okay. Doesn't mean you have to go run full speed at this market that you're not even sure you're going to love. But on the other end of that coin, I would argue that by the time you get to you're making purchases, you're probably going to know with a fairly high degree of certainty whether or not you're going to love that market. So I've got to move on here because I'm long in the tongue here. So knowledge is power. And so having knowledge is hands down the key to the real estate investing castle. And knowledge comes in 2 forms, I would argue: education, classroom style education, talking about it, hearing about it, learning about it, and then real world experience. And I would argue that it's difficult to obtain one without the other. If we think back to where we learned about how to do things, we probably learned some kind of foundation in a classroom safe setting and then went and did the thing. It's tougher to just jump right into it without having learned about it in some kind of safe setting if we're playing with live fire, so to speak. So I would argue you should go get educated and then you should go get your real world experience, because doing it the other way is a bit harder. Take a page out of my book. So education, go get one. And the following are great places to start. Bigger Pockets is an awesome forum. Read real estate related books. Read business mindset books. So much of tonight, what we're talking about is mindset related things that translate into actionable steps that you can do to help shift that mindset. Go to real estate networking events, whether online or in person. Go to real estate seminars and trainings. Do not go to those hotel ballroom trainings where they are telling you and selling you on the next greatest thing, the upsell. You got to pay 10 grand to get in, and the secrets of real estate investing. We're going to talk about it in our next class. You got to register for that. That's a bunch of baloney. Don't fall for that stuff. But there are some really great seminars and trainings that people put on. So look to vet the person that's hosting and putting on the training, and make sure they're actual real estate investors. Make sure they're not marketers. Make sure they're not just talking about how to real estate invest without actually having done it themselves. And so that's something that I really advocate for, is to go work for someone who's doing what you want to be doing. They're in the trenches right there along with you, doing what it is that you're trying to do. You can go hire a coach or a mentor. Again, make sure that they've done the things you're looking to do so that it's going to be a good fit. Because if you're trying to invest in single family homes and the coach or mentor that you're talking to is only invested in quick service, triple net lease restaurants, yeah, they're both real estate, but they might not be as nuanced in the single family space as you need them to be. So again, as you're looking for a coach or a mentor, make sure that they're doing the things you're doing and that they've done the things that you're trying to accomplish. You can go volunteer for a professional in the real estate industry. I don't think people give this enough weight or enough attention. If someone said to you, hey, I'm willing to come help you for free if you'll teach me and hold my hand a little bit and show me what it is you're doing, who wouldn't jump at that opportunity? I know I would. So one thing that I hate to see have happen is someone go up to someone and say, will you be my mentor? Please mentor me. Doesn't really work like that. Have a value proposition to bring, because when you ask someone, will you mentor me or will you teach me? Now they have to think about how they're going to do that. Or when you say, hey, can I help you? They now have to think about how you can help them. Instead, find out what it is that they're doing or what they need help with, whether by talking to their assistants or by learning a little bit about them online, and say, hey, you know what? I know you're doing this thing. I thought I might be able to help you by doing this. Would you mind teaching me a little bit on the side while I learn from you? That's a very different conversation than, will you please be my mentor? Please, please, please. Right? Have something to offer to them because you're asking something of that person. So again, some of these are classroom based, while others are real world based. And I think it's important to have both. So here are some different real estate strategies that I just want to highlight and talk about. And you may have heard of some of them, you may have heard of none of them. But I think that there are really great niches to consider when you're thinking about getting started in real estate investing. So wholesaling, some pros are it's cheap to get started and you can make quick cash and you can learn fairly easily. There are a lot of people doing wholesaling. Some cons, you need to understand the legal implications. Different states have different rules and regulations governing wholesaling and what's considered wholesaling and what's not. So just look to understand it before you do it. It's not passive. I should make that very clear from the get-go. It is not passive. So if you're looking for a passive investment, wholesaling is not the way to go. This is great for people who want to learn the real estate business inside and out. You're going to be very good at contracts. You're going to be very good at understanding how to get deals under contract. It's less ideal for people who want to own property because it's not direct ownership. You're stepping into the middle of a deal. And so wholesaling, for those of you that don't know, quick high-level definition, I'll go put a property under contract for 20 grand. I know Ace is looking for a property that meets this criteria. I'll turn around and sell that contract to Ace for 30 grand. So I make that spread in the middle, 10 grand, right? I just picked numbers, made them up, but that's basically how it works. You're going to go get a contract and flip it to somebody else. You're going to flip the right to own and buy that property to somebody else. So you're a broker, a dealer in a sense. Another strategy is fix and flip. So some pros here, you can make huge returns. And it's often less competitive because of the property condition. A lot of properties that are going to be great flip candidates won't qualify for financing. So I don't have to go compete with owner occupants who love the property to live in. I also don't have to compete with investors that are using financing to purchase properties. So this can give me a real edge. And Sean is asking, what are the tax implications for wholesaling? It's a super good question, Sean. I would go ask your CPA or a tax professional. That's a little bit above my pay grade. But what I can stipulate is that it's going to be taxed as ordinary income. So you're earning money, you're earning that income. So whatever your tax bracket is for wherever you live, that's likely what it's going to be. But I would, again, double check that with the CPA. Yeah, you're most welcome. Some cons of fix and flipping. It's very risky due to unforeseen costs and changes in market conditions. So if I go buy a property to flip, this just happened to me. Turns out there was a lot more damage behind the walls than I didn't know about, that the agent didn't know about, that we couldn't have known about until we took the walls off, until we took the sheetrock off. So you just got to be prepared and have the stomach and pocketbook for those unexpected expenses. With flips, you can also be tying up a lot of your capital, depending on how you're financing it. If you're going to go to hard money loan, less of an issue. But if you're using all cash because you can't finance the purchase, your capital could be tied up for the length of the time that it takes to close the deal, do the flip, and then sell the property. So you want to have a very clear understanding of what the timeline is that you're getting yourself into, especially if you're using hard money. Cash is less of a concern because you're probably not going to have a mortgage payment to make. But if you've got a hard money loan, you want to be very certain of what the timing looks like, how long you're expecting to hold the property, and what the hold costs are on these properties. Because it's not just your construction costs. You've got your insurance, you've got your mortgage payment if you're using hard money, you've got your utility payment, which a lot of people underestimate, and you've got all kinds of things, expenses that you have to pay for. You still have to insure the property. So you just want to have all those soft costs, all those hold costs very well line itemed out before you get involved with fix and flips. These are great for experienced investors or flippers. These could be great for someone who wants to get involved in flipping, who wants to kind of dip their toe, because you can often buy very cheap properties that don't necessarily take up a lot of cash to do the flip for. These are less ideal for people who are very risk averse, because as we mentioned, there's unforeseen costs that can arise, but also the market conditions can change. Can you imagine if you were in the middle of a flip in 2007? That was a 12-month flip. It was a really, a big flip, and the market just totally shifted on you in 2008, 2009. I hear a lot of investor stories that this happened to people. People had flipping businesses because the market was going gangbusters. They're like, I can't lose. Prices will never go down. Well, prices went down. They were left holding all these properties. And that's how a lot of my investor friends became buy and hold investors. They just said, okay, instead of flipping it, I've fixed the property. Now I'm just going to hold it and rent it out long term. BRRRR investing, it's an acronym. The guys over Bigger Pockets coined this. It stands for buy, repair, rent, refinance, and repeat. And so I don't want to get too deep into the details of what this is, but it's some of the pros. It's a really great way to recycle capital quickly. And you can end up with brand newish type properties, which is pretty cool, especially as a value add investor. Having a brand new property is definitely something to covet. And there's a lot of value in that. Some of the cons, they're similar to fix and flip. You can run into the same issues that you can with fix and flips. These are great for people who are considering fix and flips or people who have limited capital, because again, it's a great way to recycle that capital when you go refinance the money out at the end of that process. And this is less ideal for people that are looking for passivity. Again, not a passive investment. Before I get to buy and hold, I want to take a couple questions. Quincy said lean properties. Yeah, absolutely. Another strategy. Just have to be a bit more specific and very, very, very well versed on your due diligence, because you just want to make sure that that title is clear, that the lien that you're buying, that position you're buying, truly is going to get you the property. So definitely a little bit of a more experienced tactic, but another strategy, great. And Danielle is asking, is it better to invest in a property that already has a tenant? That's a great question, Danielle, and I would argue that the answers are going to be split. So I will argue both sides for you, and you can decide what makes more sense for you. So a tenanted property, you know what the tenant is, and so you can very easily calculate what your anticipated cash flow is going to be. So my expenses are X, my rent is Y, and the difference is my cash flow, be it both positive or negative. Well, we don't necessarily know what the screening process that tenant went through was, so we don't necessarily know if they're the best qualified tenant. But if they are, that can be great, because now we don't have to pay a new tenant placement fee with a property management company. And for those of you that aren't familiar, basically, if I buy a vacant property and I have a property manager manage it for me, and they place a tenant in that property, they're going to charge me a fee for that service. That can range anywhere from 25 to 100% of 1 month's rent for that property placement, for that rental placement. So you can imagine, if I have a rental, it rents for $1,000 a month. It was vacant when I bought it. I get a tenant. My property manager gets a tenant. They're going to collect that first $1,000 a month in rent, that should be going to me, but that's going to the property manager for placing that tenant. Versus you are buying an existing tenanted property for $1,000 a month. You bring on a property manager. They didn't do anything, so they're typically not going to be charging you a fee for that. And so as soon as rent comes in, you get to collect that. Now, some tenants have a tendency to test new owners. There's like this scene in Jurassic Park where, if anyone's seen it, the raptors are like testing the integrity of the fences to see where they can find weaknesses. New tenants can sometimes do this with new owners. Like, oh, I was saving all of these maintenance requests, and the old owner was not doing anything, so this is everything I want done. That can happen sometimes. Sometimes it can be a seamless transition. So if you can vet the quality of the tenant and vet the vetting process of what that tenant had to go through, what that qualifier was for that tenant, that can be great. So it can really go both ways. So better is always a tough one, because you might think something is better versus I might think something else is better. So again, it's really individualized, but those are kind of the pros and cons, if you will, of having a tenanted property versus a non-tenanted property. Another pro, I guess, would be sorry, my nose is so itchy tonight, is if you're gonna do some work on the property and it's vacant, that makes it a lot easier to then do the upgrade and then potentially raise the market rent, or raise the rent you would be commanding, versus if you buy a property with a tenant in place and the property needs work, you have to wait till that tenant's lease expires, likely, to do that needed work. So a lot of moving parts, different things to think about. Hopefully that's helpful. So buy and hold is the last strategy we'll talk about. And some pros is you have time on your side, which can often repair mistakes. So they say time heals all wounds. This is definitely the case to a degree in real estate. You don't want to buy way overvalued. You don't want to buy wrong. Everyone says you make your money when you buy, which I tend to agree with. But even if you do buy a little bit wrong, time can usually help repair that wound. And you can leverage long-term debt for loan pay down over time, which is amazing. That's one of the 4 benefits of real estate investing, is this thing called loan pay down. And you've probably talked about loans and financing in some of your other classes, so I won't get too into it. Some of the cons is that its growth tends to be slow. And so if you're someone that's like, grow, I want to see those returns now, to the moon, real estate's the best, it has to be amazing, 100% return, probably not a great fit for you. And we often consider buy and holds more of singles and doubles as compared to home runs, which we tend to see with BRRRR investing or fix and flip investing. So things just take time to materialize. And again, boring is great in my opinion. So I'm a major fan of buy and hold investing. So this is great for people looking for a steady investment. Slow and steady wins the race. It can often be that reliable investment that you can have as part of your portfolio for forever, potentially. And this is less ideal for, as I mentioned, people looking to make big returns quickly. This is just not a good vehicle for that, unless you're able to force appreciation very quickly, which is kind of more of a BRRRR strategy. So you can combine multiple of these, by the way, but your traditional buy and hold, buying a turnkey asset, holding on to it for a long time, doesn't tend to generate massive returns. It will over time. It will over the time of ownership, and it will often outperform a lot of other asset classes because it pays you in 4 different ways. I'll talk about that in a minute, but just something to know. These are 4 strategies that I like talking about. So it's really, really important to know thyself and categorize your strengths and weaknesses. So some examples of typical duties and responsibilities, I broke it down into kind of 4 different roles. So you've got your financial roles, running numbers, analyzing deals, and finance sourcing, right? If you're not good at this, go find someone who is, or go be better at it. Go learn how to do these things. Figure out what you're good at and what you're bad at. Focus more on the stuff that you're bad at, because you want to be good, proficient across the board. And if it's not something you can do or are willing to do, you maybe need to go bring in a partner who can do those things. And a great partner, by the way, is kind of a yin and a yang. It's someone who complements the things that you're lacking in. So a lot of times best friends will go into business because they love the same things, and they're good at the same things, and they jive so well together. That might actually be the worst partner you have, because you're both good at the same things, and so you're both lacking the same things. So finding someone that complements your weaknesses, and is weak where you're strong, is going to be a really great potential partner for you. Relationship aspect aside, just from a hard strength and weakness perspective. Then we have relationship roles. We've got networking and keeping your team members happy. So again, if you're not good at this, go get good. Task roles. So that can be deal sourcing and then managing the manager. This is something that we have to do if we're going to go buy deals. We have to find a way to get deals. And so we also have to manage the manager if we're using property management. And then we've got managerial roles. So we've got bookkeeping and accounting, and then tax returns. So knowing, again, if you're good at this or not is really, really important. And again, brushing up on the areas that you're weak in. Can't overemphasize this enough. So I told you we're going to come back and talk about SMART goals. It's an acronym. It stands for specific, measurable, attainable, relevant, and time-bound. And every goal that you set, I would argue, should be a SMART goal. And I'm not going to read through all these things, but all you need to remember: specific, measurable, attainable, relevant, and time-bound. And if you're super interested, you can Google what a SMART goal is, and you can dive deep into it, or you can rewatch this recording and pause here. But a poor example of a SMART goal is, I want to purchase an investment property. Doesn't really tell us a whole lot in terms of specific, measurability, attainability, relevancy, or time-boundness. What is a better example of a SMART goal is, I want to purchase my first single-family rental within the next 10 to 12 months with a purchase price no more than $200,000, with an average monthly I'm getting tongue-tied. An average monthly cash flow of $200 and a minimum cash-on-cash return of 7%. That tells anyone reading it exactly what it is I'm looking to do. And it also allows myself and others to benchmark, did I do it? Have I done it? Have I made good on my goal? The prior one, purchase an investment property. Anything meets the criteria as long as it's an investment property, but this is a very specific thing that allows me to measure myself. How am I doing? And so it's really important to set up benchmarks for yourself at very specific intervals to check in and see how you're doing against your goal. And don't beat yourself up over not hitting your milestones, and don't be afraid to pivot on your goals or your timelines. I know too many people that said, I'm going to do this, I missed my goal, I'm the worst person ever. And you beat yourself up and you self-deprecate, and it's not healthy. And again, remember, most of us are doing this for ourselves, for intrinsic reasons, for ourselves or our family. 99% of the time, the only person involved is ourselves, and that's who we're letting down. So we've got to be able to reckon with ourselves. It's okay. We miss goals. We just readjust, reset, and keep moving forward, because beating yourself up doesn't do anybody any good. Again, this is all speaking from experience. So now let's get into some pro tips. So see below for numerous cheesy platitudes. So number one, don't be afraid to fail, because I promise you, like, there are no guarantees in life except death and taxes, I think they say. I will guarantee you that you're going to fail at some point if you're in this business long enough. And I would argue that you haven't been around long enough until you failed. So you're going to fail at something, and that's okay. Once you've rid yourself of that, oh my gosh, I don't want to do anything because I'm afraid of failing, things become a lot more easy to accomplish. It's when we're tight, when we're so worried about screwing up, or when we're so worried about failing or making the wrong choice, making the wrong call, that we become paralyzed. And so some of you may have heard of analysis paralysis. You may have talked about it in some of your other classes. And it's that inability to make a decision because you're going through all this analysis. You're trying to check all the boxes that it prohibits you from actually moving and doing something. And by the time you're able to move, the deal is gone. And so that's why I talked about in that snake chart, that flow chart, sometimes we have to shoot first and ask questions later. So again, you want to get comfortable with being uncomfortable. And so it's simply not a matter of if things will go wrong, but rather when they will. So be prepared. So if we're prepared to fail, we're not afraid of failure. We know that if we do fail, we're just going to fall forward. Then our only options are to win or learn. And someone told me that once, and that really resonated with me. Sean's asking, what is the most valuable thing you've learned from one of your failures? My very first investment property, I talk about this a lot on the podcast. I'm a real estate investor. By all accounts, should have made me quit real estate investing. My very first tenant, the police got called on them. They smeared human feces on the way out of the house. They trashed it, about $10,000 worth of damage on the way out. And I did not have a $10,000 deposit from them. It was about a $2,000 a month rental. I had to take these folks to small claims court. I mean, it was like this 18-month endeavor that was just like literally hell on earth. And if I look back and I was telling myself what was going to happen, there's no way I would have continued investing in real estate. Like that just shouldn't have happened. It shouldn't have happened to begin with, but the fact that it did sucked. And I should have quit. It would have been so easy to say, everyone was right. This real estate investing thing is crazy. I couldn't possibly be expected to own this thing hundreds of miles away from where I live. But I just said, okay, hopefully the next one is better. And it was. And I said, okay, well, I hope the next one is even better than that. And it was. And as long as the subsequent deals that you do are better than your prior ones, you're moving in the right direction. And so don't worry about the stuff you got to deal with and the crap, like literal and metaphorical, that you deal with at the beginning of the phase, because we're not good at real estate investing when we start. No one is. And if they are, they're just very lucky and it's going to catch up with them at some point. And so it's just like anything new. When you go play a new sport or learn a new game, you're not very good at it because we haven't done it. We haven't practiced it. And so I don't know why we expect that of ourselves, but I feel like we do. I mean, I'm so guilty of it too. I was doing something new I hadn't done before and I was pissed that I wasn't good at it. Like when you look at that and you can kind of say it out loud, it sounds silly. And so again, if we can just be gentle with ourselves and understanding that, okay, this is a process. I'm going to make mistakes. I'm going to have a learning curve, but I'll get through it. This becomes a much easier pill to swallow. And learning small. There was this movie, I think it was The Patriot with like Mel Gibson, who's a questionable human being, but it was a good movie. And there was a line when his son is taking aim at some British soldiers, and he says, "Aim small, miss small." And I thought that was such a great line because when you're not taking massive risks, you're not going to make massive mistakes. And so you can learn on small deals, small properties, get your growing pains out of the way, and then move on to bigger deals. And so I've had consulting clients that's like, Michael, I've got the first deal, $1 million, 10-unit property. I want to get into multifamily. It's the best. I love it. I've done my research. Great. I was like, okay, well, have you invested in property before? No, never. Okay. Well, do you think you're going to make mistakes? Yeah, definitely. All right. Well, do you want your mistakes to be on a $1 million property on a 10-unit building, or maybe a single family home, or a smaller purchase where the stakes aren't as high? Well, I haven't really thought about it that way. So it's important to be hungry and to be a go-getter and to push yourself, because that's where I think growth really happens. But you also want to be cognizant of your own limitations, and especially if you're just starting out, there are ways to learn that are less risky than others. I was tempted to say risk-free, but there's no such thing as a risk-free investment. So you want to find a way to get your growing pains out of the way, because single family is single family is single family, and multifamily is multifamily is multifamily. And so once you learn the fundamentals and the basics, you can take that and apply it to all your subsequent deals that you do. So hopefully that answers your question, Sean. How do you come up with your minimum profit for each deal? That's another great question. It's very personal. And so it needs to reflect, for me, it needs to reflect the risk and work that I'm taking on. So on that turnkey property, my very first property that I purchased, it was a bit unique because I purchased it with an interest-only loan because the numbers weren't strong enough on the rental side to support all of the expenses. So on that one, it was like an 8% or 9% return. I mean, it was nothing amazing. But that makes sense because I wasn't doing anything amazing. I just bought the thing turnkey, walked in, put a tenant in place. They smeared poop on the wall, but that's on them. Versus my value add properties that I look to do, I'm targeting 15 to 20% returns because there's so much risk involved. I better be getting paid out the wazoo for that kind of thing. If I could go buy a 20% cash on cash return rental off the shelf that was turnkey, I would do that in a heartbeat as compared to doing the value add. Because why would I go through the headache and heavy lift and expose myself to all this risk by doing all this value add if I could just go get that off the shelf? And so that's where you tend to see cap rates come in, is for your more turnkey stuff, they tend to be lower cap rates. So it's more expensive property as compared to the same return for the same value on another property. Versus that kind of junker stuff, it's advertised at a higher cap rate because there's risk involved. So hopefully that answers that question as well. But these are great, so keep them coming. So just some kind of personal anecdotes to share a little bit about myself with you all. I'll open the vest a little bit. So that first property that I showed you, let me get back to it really quickly. I hope this doesn't make anyone dizzy. So this property, actually, this was that property I'm going to share with you in just a minute. Junked up, beater, like just so gross. There was bats living in the top floor of this property. So This was a deal that I did, bought it for 365. It was 12-unit mixed-use building, which means that there was residential on top and then commercial on the bottom. The rents at the time I purchased it were about 3,200 a month. We did about 140,000 in value add. So we updated units, mechanicals, made the commercial spaces nicer. And then I was going to hold it for a while, but I decided, you know what, this building's kind of a pain in the butt. So I recently sold it. The rent was 7,200 at the time of sale, and we sold it for 715. And so 365 plus 140 is like 400, 500. So we sold it for about a $200,000 profit. And so this is the power of value add. And I could have done a BRRRR on it, but I kind of wanted to be done with the property. It was really old and it was kind of death by a thousand cuts kind of a thing. So it was just a pain in my side. So I said, let's just get rid of it, because somebody else can add some additional value to it. They're getting a great deal because the area is exploding. I was able to add some value, and so I can harvest that back and then go deploy those dollars elsewhere. And so I did a 1031 exchange out of this property and into one that was a short-term rental out in the Midwest, which I'm very excited about. Very much less headache. So I took a little bit off my plate and simplified my life. Another project that I worked on was I did a 4-unit complete gut rehab down to the studs. And so I purchased it for 90,000. The rent I purchased was 600 bucks, excuse me, 1,600. It was 400 per unit. I spent about 380,000 on the rehab, and then the rents jumped to 4520, and the current value on that's about 525. So that's another example of value add. And this was one where we took down the walls, and my contractor calls me and says, Michael, we need to put all new electrical and all new plumbing in all of these units. And I was like, crap, didn't budget for that, didn't anticipate that. And so this was technically a BRRRR, but it could have just as easily been a fix and flip. And so I had to find the money to do that, because you can't stop construction midway when you get bad news. And so I can't say, well, put the walls back up, we'll worry about the shoddy plumbing and shoddy electrical later. He's like, you're going to pay for it now or you're going to pay for it later. So again, just having the stomach for that kind of thing and having the financial backing wherewithal to be able to handle those types of things if you're going to be doing these types of investing. So Tyler's asking, how has COVID affected rent payments? I am very lucky, knock on wood. I have had very little rent deferment or lack of rent payments. Actually, my worst one is in California at my highest price point rental. That's the only one where we've seen a just lack of payment due to COVID. But there is some relief coming, thankfully, which is great. Yeah, I can absolutely talk about the importance of finding a good contractor, Rick. This is paramount. And this is important if you're doing any kind of value add work or upgrade work or rehab work. Your property manager, if you're using one, likely has ties, connections, maybe even in-house to good contractors, because they're constantly doing maintenance work on properties. They might even have a division that handles turns or rehabs. If you've got to do a new kitchen or put in new flooring or whatever, they're going to tell you what the extent of their capabilities are. And so you want to understand, is that a good fit for your project? Who's managing the project? Is it something that the property manager can take on, or is it something that you're going to have to do? And if you have to take it on, do you want to hire a project manager? I'll talk about on the next page project I'm working on that I wish I had hired a project manager for, because it's way over my head. But I didn't know that until I was too deep into it to know otherwise. So good contractors should have good references. They should have very good communication. That's not always the case. Some of the best contractors I know don't communicate well, but if you can't communicate with them, are they a good contractor? That's for you to decide. So get references, get pictures of other projects they've worked on, get very clear about how and when people get paid, because you can see these projects go sideways very quickly. And so you just want to have really good conversations up front before you get into a deal with a contractor, before you get in bed with them, so to speak. So let me jump to this next page here. So this is another property I worked on. So 6 unit, we purchased it at 90K. It was definitely a value add play. The rent at purchase was 600 bucks. It was like 1 out of 6 was occupied. We spent 35,000 in updating the units, new paint, new flooring, a lot of new fixtures, new mechanicals. And then rent to the sale was 3,200, and we sold it a year later for 205,000. So again, another value add play, which worked out really nicely. And then this most recent project I'm working on that has caused me a lot of brain damage over the last couple of years, is a mixed use property. I tweet about it fairly regularly about some of the issues that I've had with it. I had 2 fires back to back, a week apart in the same property, which coming from the fire protection industry was not only embarrassing, but pretty astonishing because it's statistically nearly impossible to have that happen. So that was really interesting. It was originally 4 units commercial and then 4 units residential. Upon completion, it'll be 15 residential units and 2 commercial units. So it's a mixed use, redevelopment project. Purchased it for 642. Rents at purchase was 2,500. Estimated rehab budget is about 1.5 million, and projected rents upon completion should be about 22,000. So this is definitely a project I wish I would have brought a project manager in on. I'm dealing with all kinds of stuff that I'd never dealt with before. Part of the reason was the scope had expanded during the course of the project, which is very unique, but I won't get into that. I could do a whole nother teaching on this project specifically, but hoping it's going to be done in the next couple of months and we're going to get it leased up and going to put the rest behind us. So, and then last but not least, I've got 2 properties in Lisbon, Portugal. I purchased one for a golden visa, which is kind of a unique program that Portugal has as a way to get a second passport. And I purchased one as a flip because I flipped in the US. I figured, why shouldn't I be flipping in Portugal too? I actually decided to keep the flip property as a rental because I'm able to get really great financing terms on it, 60% loan to value at 2% for 30 years, which is like unheard of in the States. And so both are going to be short-term rentals, which I'm very excited about. Okay, so lastly, I think this is my last slide. Yeah, so I do personal coaching consulting. I've coached over 700 people who have purchased over 35 million in real estate. My typical rate's 25 an hour. If you're interested, shoot me over an email at my below email, mention the Wealth Squad, and I'm happy to give everybody a reduced rate as part of hanging out with me for an hour here. Joshua was asking, how do you evaluate a potential good deal numbers wise? It's a really great question. Evaluation should be uniform. That is like without a doubt. And it really frustrates me that there's a lot of different calculators out there that talk about a lot of different ways to evaluate things. In my mind, it's very black or white. It's very binary about how you do things. You take your rent, that's your top line. You take out your mortgage payment if you have one, and then you take out all of your operating expenses. And your operating expenses should be your property taxes, your property insurance, your property management fees, your monthly property management fees, and your releasing fees, by the way, which a lot of people don't take into account, and it hammers them sideways when they come get a new tenant. And if it's not a releasing fee, it's a lease renewal fee. So that can also catch you upside the head. Your maintenance and repairs, your excuse me, your CapEx reserve, and then your turn reserve. And so you subtract out all those numbers, and whatever you're left with, that's your cash flow. Now you take your cash flow number, that's your monthly cash flow, you multiply it by 12. That's your annual cash flow number. And again, if it's negative, it's same math. It's just going to be a negative number. Then you divide that number by what you put into the deal. So let's take a quick example here. I'll use my calculator. Let's say you buy a $100,000 rental property and you put 20% down. So you're getting an 80-20 loan. And so let's say it cash flows $100 a month. We'll make the math kind of easy. So $100 a month times 12 is $1,200 a year, divided by the 20 grand we put into it. And we're forgetting about closing costs, by the way, in this equation. We can add them in or we can leave them out. I would add them in, probably, because that's your true cash in. But let's forget about that for a minute. So we're in it for 20, and we're making 1,200 on an annual basis. So 1,200 divided by 20 grand is 0.06. That's 6% cash on cash return. So if that's a acceptable metric for you, an acceptable return for you, great. If you're someone that's used to getting 1.5% in the bank and you're just getting started in real estate and you're like, holy crap, I can get 6%, amazing. That could be a great investment for you. If you're someone that's scaling and owns a couple of properties already and you're like, nah, I'm not used to getting 7, 8, 9%, I'm not getting out of bed for a 6% return, maybe it's not a great deal. Or maybe you ran your numbers wrong. Maybe you were too conservative on something. Or maybe you need to look to engineer how you purchase the property. Because maybe if you put down additional down payment, that'll translate to a lower interest rate, which will translate to a higher monthly cash flow number, which may ultimately translate to a better cash on cash return. There's no way to know until you run the numbers. But that's the methodology I go through every single time when determining how to evaluate a property. And by the way, I get told all the time, your numbers are too conservative. Great. That's music to my ears, because that means that I'm not going to lose. I'm not going to get caught off guard. I've been in this game long enough to see that expenses pop up when we least expect them. And so if I'm prepared, I'm not going to get caught off guard. And if those eventual repairs do come up or those expenses do come up, I'm ready. So Janae is asking, what do you consider a short-term rental? So most jurisdictions consider a short-term rental to be something that's less than 30 days. And so my primary residence, my wife and I actually converted to a short-term rental when we moved into our van, and it's a condo. And the HOA says you can't do short-term rentals. So it's 30-day minimum, excuse me, 30-day minimums. So we were like, awesome. I mean, kind of perfect time during COVID when everyone was remote anyhow. So we did 30-day minimums and had 0 vacancy for about 7, 8, 9 months, something like that. And now we just rented it out actually to a full-time tenant for a year lease at the same rent that we were getting on the monthly basis for a short term, which is just amazing. So we're ecstatic about it. So hopefully that answers your question, Janae. And Derek is asking, what tools do you use to locate properties? By the way, this is the end of the presentation. So we're at our Q&A section. So I'll leave this up for my contact information if anybody wants to reach out. So what tools do I use to locate properties deals? I like agents. Like local agents tend to be my best resource for a couple reasons. One is they'll have access to listings that you'll never see. That's called off-market deals. So if I'm someone that performs, me personally, Michael Albaum, is someone that buys deals and closes, and I'm working with an agent and I can convey that to the agent, they're likely to bring me deals that they're not going to bring to anybody else because they know I can close, they know I can get the deal done, and it's easier for them. So think about it, if you're a salesperson and you know someone is in the market to buy what it is you're selling, why would you go market it to a bunch of other people when you could just take it to that one person and give them exclusive access? So agents are great. A lot of people think they have to do all this work themselves sourcing deals. You don't. That's what agents get paid for. And so if you've never purchased real estate before, the agents get paid from the seller, from the sale of the property. And typically it's about 6% that gets split 2 ways between the buying agent and the selling agent. So I don't have to go do the work myself. I can. I happen to be fairly good at it. And so you might be very good at it too. And so you might be finding deals faster than your agent because they're helping serve a lot of different people. And that's okay. But I like using agents to do the work for me on my behalf because they know the market. They know what price point things are moving at. They know what it takes to get deals done. They can give you some insights into pros and cons about a market. But I will issue this word of caution: be wary of agents' pro formas. And a pro forma, for anyone who doesn't know, is just a fancy term for a operating cost projection, or a budget rather. So it's usually 12 months looking forward. You also have year-end pro formas, but those are typically called P&Ls, or profit and losses. So a selling agent, if I'm an agent and I'm going to list a property and I'm going to put together a pro forma, I want to make it look as good as possible because I'm selling the property. I want it to move quickly. Or if I'm a buying agent, I also want to make the pro forma look good because I want someone to buy it because then I get my commission. So I'm always very, very skeptical and basically trash immediately agent provided pro formas, and I always go make my own. So we can rely on them for actual numbers, for historic numbers, which is something that I always recommend people ask for as part of their due diligence process, which is something called a T12. So it stands for trailing 12 months of income and expense numbers. I want to see how the property actually performed and compare that against the numbers that I'm projecting. So is that helpful, Derek? Hopefully that answered your question. And Sarah's asking, would you recommend buying properties in different states under separate LLCs? Oh, that's a great question. It's above my pay grade. Definitely a great legal question to ask an attorney because everyone's situation is different and everyone's risk tolerance is different. And so the idea and thought process behind bucketing all of your properties in different LLCs is that your exposure from within that property stays within that LLC. So you're kind of siloing and bucketing all these different properties. There's definitely merit to that, and I subscribe to the pro LLC camp. There's 2 camps. There's no LLC camps and pro LLC camp. And so I subscribe to the pro LLC camp, and someone just asked to see the education slide. There you go. So if you're in California like me, the LLC per LLC costs $800 per year just to have it. If I open an LLC called Michael LLC and I didn't do anything with it, I never bought a property, I didn't start a business. Y'all can see my dog in the mirror there. That's Bodie. Did nothing with it. I would still pay $800 a year to the California Franchise Tax Board. So above and beyond the asset segregation and liability protection that you get with an LLC, you just want to understand what are the costs associated with the thing, and what do I have to do to start an LLC, and what do I have to do to maintain an LLC, and what do I have to do when it comes time for filing my taxes? How does that work? So you're going to have separate bank accounts. Depending on if it's single member or multi-member, you might have to have separate returns. So it just adds a layer of complexity, but it also adds a layer of protection. So you've got to decide for yourself if that's worth it to you. Now, I personally invest in different states under a single LLC. I have multiple LLCs across my portfolio, but I have property in California and Alaska that's owned in the same LLC. I have property in Ohio and Kentucky that's owned in the same LLC. So I've determined for me that that's worth it and makes sense both financially and holistically for me. So again, great question, but definitely want to chat with a legal expert as well as a tax expert to understand just what the implications are for doing so. So what channels do you use to find available wholesale contracts? Bigger Pockets and Facebook are probably two of the best to find wholesale contracts. I personally found the deal that I purchased through my wholesaler was via an agent that I was working with. And again, that didn't cost me anything because like the wholesale contract, yes, of course did, but it's not a deal I would have access to without the wholesaler. But having an agent who knew the wholesaler prior to me was kind of nice because like, oh yeah, I know the guy, I've done deals with them before, kind of a thing. So that's always helpful. So, okay, glad that was helpful, Derek. Awesome. So I'll just click back to this final slide. Yeah, here we go. So reach out to me at mikealbaum@yahoo.com. If you'd like some coaching consulting, again, this is something I do professionally. It's a lot of fun. If you couldn't tell, I'm very passionate about real estate. I'm at Twitter at Michael Albaum. Feel free to reach out to me there as well. Any other questions that I can help answer for folks? Sean's asking, what was your plan for buying 10 houses in 10 years? Were you going to leverage an FHA loan, conventional or cash? Yeah, so for me, it was literally just conventional. So I had a really good paying job as an engineer in California, and I was living well below my means. And so my rent was very inexpensive to compare to the salary I was making. And so I was just going to invest 20% down once a year, every year for 10 years. And I was for no other reason that it sounded good. I was like, yeah, that sounds about good. If I'm making about $200 a month cash flow times 10, that's $2,000. That's awesome. Let's shoot for that. And that was when I was so green. I didn't really have a more strategic plan or a more thought out plan. And so it was just like, hey, like rinse and repeat kind of a thing. Chris is asking best FHA loan advice. So I've personally never gotten an FHA loan. I'm flirting with the idea right now for my next primary purchase. But for anyone who doesn't know, FHA stands for Federal Housing Authority, and it's a way to purchase properties. It's got to be owner occupant that allows you to put, I think it's as little as 3 or 3.5% down, something like that. And so you just have a very low barrier to entry because that tends to be the biggest hurdle to overcome for folks is that 20% down payment. And so if you get into a property for 3.5% or 3% or whatever the low amount is, it tends to be a lot more accessible for a lot more people. And so that's why the Federal Housing Authority came out with this program to encourage homeownership. A couple things to keep in mind. You're going to likely be paying PMI, which is private mortgage insurance, which is basically until you have 20% equity in the property, it's a insurance that you have to pay the lender until you get that 20%. And then your monthly payment is also just going to be higher because you're borrowing more money. So FHAs can be very powerful, again, because they have a low down payment requirement. So what I love to see people do is get an FHA loan on a fourplex and house hack, or get an FHA on a house bigger than what you need and house hack. And for anyone who's not familiar with house hacking, it's basically buying something bigger than you need, whether in room, bedroom count, square foot count, or unit count, and renting out that extra space because it can allow you to live cheaply or live for free. And so it's like this really amazing way to get into property. And I think you can get like one per year. And so Nicole's asking, can you technically get an FHA loan and Airbnb it? That's a really good question. I'm not sure because again, I've never gotten an FHA loan. My guess is that there's stipulations inside the mortgage docs that you'd want to understand. But another way to ask that question is, hey, can I rent this out to roommates, or can I rent this out on Airbnb while you're living there? I don't think there's any stipulations around what you can and can't do in your own property if you're living there as the owner occupant. So I would look into that specifically in your lender clauses, but I don't think that it's not allowed. And let's see, do you advise people to get an investor groups like TribeVest or crowdfunding for an investment? I don't know what TribeVest is, so can't comment on that, Danielle. But crowdfunding, yeah, that can be a great way to get into an investment. And again, it really depends on your goals. So I've used Peer Street and Fundrise for investing in some different deals. I have not been overly impressed. And the thing you just want to remember is those are like, Peer Street is you're investing in the debt side, so you're getting whatever the return of the mortgage is, versus Fundrise is you're investing in the deal itself, and so you can participate potentially in the upside. It's kind of like a syndication, and so you're going to get a return monthly or quarterly, but it's not a direct ownership, and so you don't control the deal. From a just getting started standpoint, it could be a good way to get exposure to just the real estate investment space. And it would be awesome if you could kind of get your hand held a little bit and a peek behind the curtain, if you will, as to how that owner operator is putting the deal together, how they're doing the deal, because they tend to just be very big deals. Now, if your friend came to you and said, hey, I'm putting together this deal, like, you want to put in $5,000, that could also be considered crowdfunding or syndication. That can be a really great way to go about it too, because then you're much closer to the deal, and so you tend to be able to learn a lot more about it, versus one of these bigger platforms. They're not going to tell you what kind of due diligence they're doing. They're not going to show you how they did it. They're not going to show you how they ran their numbers. That's just not the business model behind them. But from a holistic standpoint, yeah, it can absolutely be a great way to get started. These are all really great questions, everyone, so please keep them coming. I've got a few more minutes to share with you all. If there's no more questions, I'm not going to keep everybody, but I'm happy to stick around for a few more minutes. Joshua, thoughts on Section 8 housing? Love it. It's a good question, Joshua. And so Section 8 housing is, anyone who doesn't know, is government assisted housing, and it's run locally at the local level by every local PHA, which is a public housing authority. And so every local public housing authority is slightly different. Excuse me, it's regulated at the federal level. And so the commands come down from on high about how the program needs to run, but how it's actually run is up to the local kind of ordinances and governments. And so you could have a great experience in Nashville, Tennessee with Section 8 and have a horrible experience in Tucson, Arizona. So as a holistic level, 10,000 foot level, I like it. It's great. Folks who are on Section 8 housing vouchers don't want to lose them, because that's a big problem for them. And your rent is guaranteed essentially by the government, or often a portion, sometimes the whole thing. And they'll often pay higher than market rent. So what a great incentive for owners to open their doors to folks that need a place to live, that need a safe, reliable place to live, and are going to get paid potentially more than market rent for it. So it can be really great. You just want to work with someone that understands Section 8 in that market if you are going to be using a property manager. So if you're using a property manager, you want to ask them what their experience is with Section 8 and what their experience is like with working with that local PHA, because you don't want to be the guinea pig that has to go through the manager learning how to operate a Section 8 property and navigate those Section 8 channels with your property. So hopefully that answers your question, Joshua. So yeah, you're welcome, Danielle. So Sean's asking, what's one thing you wish you knew before you bought that first property, especially with it being so far away from where you lived at the time? That's a good question. I think I just wish someone would have told me like it's gonna be okay. And I think I kind of got that at the beginning, and I was freaking out like when I signed the mortgage documents, because it's a big number. It was a really big number. And I'm like, oh my God, I'm like signing up for all of this debt, way more debt than I had ever thought I would take on in my life. But when you look to understand and break down in bite-sized increments, okay, yes, I owe this much money, but my obligation every month is like, it's like this, and my rent is like this. So I'm good. And even if there was no rent coming in, could I afford this much payment every single month? Because I had a very strong paying job, I could. And so when I was able to kind of take a step back and break things down a little bit and say, okay, well, yes, I'm responsible for all of this debt, but in 30 years, it's a pretty long time horizon. So understand what your monthly exposure is it makes things a bit more digestible. And it probably would have helped me gotten there sooner. So I think that's what I wish someone would have told me is like, hey, it's going to be okay. It's going to work out. Even if the market goes down, rents tend to stay fairly strong. And so don't let yourself be too concerned with that in the long run. Nicole is asking, you mentioned your plan was one house every year. Can you explain why having multiple homes wouldn't count against you to get funding for the next purchase? Yeah, it's a great question. So what Nicole, I think you're talking about is your debt to income ratio. And so as you take on more debt, that ratio goes up. But if you're purchasing cash flowing rentals, your income also goes up. So while your debt does go up, your income should go up higher or at a faster rate, again, if you're cash flowing. And so I would definitely chat with some local lenders about how do they calculate debt to income. And if you're thinking about purchasing properties or getting a loan for something, you want to understand what your debt to income is. And so just simply ask that question. But really good question. Chris asking, best resource for the ins and outs of taxes with being a homeowner and sheltering income. CPA. CPA is going to be your best source for that because it's different for everybody, depending, again, on where they are, what type of assets they have, what type of income they have, and then geographically where you're living. So I live in California, so I pay state income tax. Someone living in Nevada doesn't pay state income tax. So there's going to be a difference right there. But the cool thing about just taxes in general for your pure investment property is like the vast majority of dollars you spend are going to be a deduction. So your interest, mortgage interest is a deduction. Your property taxes is a deduction. All of your operating expenses, every dollar you spend on that property to own and operate it is going to be a deduction. So that's awesome. So when you think about what your true cash flow, what your true return looks, you've got monthly cash flow in terms of usable dollars, but then you've also got massive tax benefits that you're going to have working for you as well. So chat with the CPA to understand, okay, this is your financial picture, and this is what it might look like post owning rental property. How do you determine the value of an as-is property? Comps for residential property. Hey Danielle, I'm just going to mute you here. I think you were unmuted. So comparable sales is what determines the value of residential property, and for commercial property, that's cap rates. And it's simply a function of how the building performs and what kind of condition it's in. So think of it as you're buying a business, you're really buying a cash flow. And so understanding what the market going rate is for that type of cash flow is what gives you your as-is value. And your agent or realtor should be able to pull comps for you for as-is properties. And then also Zillow is actually fairly good. If you click on the yellow filter, there's the red filter is for sale, the purple is for rent, and then yellow is previously sold. And so you can look at any time frame, but I would look at the last 90 days, six months or so in that area for that type and square footage of property to see what things are trading at. What are ways to get into real estate with little or no money using good debt to get into real estate? Partner, find someone in everything in life, like find someone that has what you don't. And so if you have dedication and you're wanting to learn this business and you're able to find deals, but you don't have money, go find someone that has money but no time, or has money but doesn't know how to invest in real estate, or has no desire to invest in real estate. That's what I've done. I found cash partners and said, hey, look, you're getting great returns, go invest for me. And then I get a cut of the deal. So that's one way. Another way is to look for owner financing, seller financing. So finding properties that are mostly paid off or fully paid off, this works really well. And then the seller becomes the bank, and you pay them a monthly mortgage, if you will, on top of whatever your down payment you agree upon is. This is a really great way to get into deals with little or no money. And then using good debt to go into real estate. I mean, I would argue that debt that you go into to earn a return that's above and beyond that debt amount is a good use of debt. And so if you're buying cars to flip and you can use debt to do that and you're making a return, like I would argue that's good debt. Bad debt is buying depreciating assets or things that don't get you a return. And so a lot of you might not like me after this, but I would argue that buying a primary residence is a liability. It's not an asset, because it costs you dollars every single month, doesn't put money in your pocket, versus an asset puts money in your pocket every single month. I subscribe to the Kiyosaki definition of asset. I was nice to hear a lot for cash flow or rents are tax-free. That income do not have to report. So that income, Nicole, for anyone who's listening and has any question, I hear a lot of the cash flow or rents are tax-free. Is that income that you do not have to report? What that likely is, Nicole, is because of the depreciation factor that you're going to get on your rental property. So basically what depreciation is called a paper loss. And basically what that means is it's a calculated form of an expense is how it shows up. And what you do is you basically take the building value of the property, and if we're just throwing mud at the wall, we can use the figure of 80%. So let's go back to a $100,000 property example. Of that $100,000, 80% is probably in the building value. And this will show on your tax record. They'll tell you what's the building value, what's the land value. 20% is probably the land value. So what we do is we're going to take standard depreciation is 27.5 years for a residential property. And so we're going to take 80 grand and we're going to divide it by 27.5. So 80,000 divided by 27.5 is $2,909. This is the amount of annual depreciation that we're going to take, because the government basically says that real estate is a depreciating asset, even though we in the ownership world and investing world know it as an appreciating asset. It's like a piece of equipment for business. We say that that loses a little bit of life every year. And the government has said that a piece of real estate has a usable life of 27.5 years. And so we get to write off a little bit of that usable life every year. And it's a straight line. It's the same amount every year, sometimes. And that's straight line depreciation. In this case, we're calling it 2909. Well, in our example we were talking about, you made $100 a month, $1,200 a year. Well, I made $1,200 a year and put that in my pocket. But the government tells me that because of depreciation, I get to actually write off 2,900. So on paper, I'll actually show a net loss of $1,709, which can be used to offset other income I've earned. And this is getting into a whole nother discussion we could have. I'd love to bring on a tax professional, or Ace, you could have on someone to talk about taxes in real estate and how this works and how it's actually reported. But so Nicole, from your question, in this instance, all of that income, all of that $1,200 that I actually put in my pocket that I can touch and spend and use is tax-free. And so if I earn income from another job as a wage earner or from other properties, I've still got $1,700 of loss to use to offset additional income. So real estate is a very, 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 very powerful tool from a tax perspective. So just keep that in mind if you weren't convinced, if you weren't already sold on the other benefits. Hopefully that may have pushed you over the edge. So I think I've tackled all those questions. I've got to run here in just a minute. Thanks everyone for hanging out. Ace, thanks so much for having me, man. Hopefully this was valuable for everybody.
First and foremost, before you get out of here, man, I really just want to say thank you for coming on here and dropping all the gems that you did, man. You had me over here smiling. There were so many times I wanted to just hop in, but I wanted to let you do your thing and have it. But no, seriously, you know, I know our members appreciate you a lot, and I really do. And you know, before you go, I was over here taking notes, man. I'm a note taker. So
Yeah.
some of the things, can you bring up your slide, your contact information really quick too, please?
Yeah.
All right. Yes. All right. So I was taking notes. So some of the key points that you were saying through all this, and if you guys tapped in later, you guys missed this. This is going to be recorded, and you guys will be able to go back, rewatch it, and pause. And I really want you guys to go back and watch this again, because Michael went over a lot of things that we've already covered, right? So, you know, one of the things I love bringing people on, because you just re-hit the nail on stuff that I've already talked about and preach about, but it's like, you know, they're hearing me constantly preach about it over and over again. So it's great
Yeah.
to have a new face and a new voice come on and just re-preach those things. So please, you guys go back, rewatch the previous videos, and a lot of stuff will click what he's talking about as far as certain terminology and things like that, right? But one of the key things that you said is, you know, you're not going to fight with people about real estate, right? So many people are like, well, I shouldn't do this or I shouldn't do that. That's something that I like a lot, right? If it's not for you, it's not going to be for you. That's fine. Real estate doesn't have to be for you. It's going to be for who it's for. And once you get in that boat, you're going to be glad that you did, right? So that's one of the things that you said. You talked a lot about mindset shift. That's a big thing that we always try to reiterate in the Wealth Squad. And just in general, you follow me on social media, so you should always see we're always talking about mindset shift. And that's one of the big major things, and especially when you guys go into real estate, I talk about how I don't have any real estate background. You didn't have any real estate background. So it takes a mindset shift to really get this stuff going. And it kind of, talked about another point that you said is don't be afraid to fail, right? Because when you're learning something new, you're going to fail, whether, even if things are going good, there's still going to be bumps in the road. There's still going to be hurdles that you're going to have to overcome. So I really like that you hit that on the nail. And, I like that the education and real world experience. I like those two key points that you talked about. So really great video. Really appreciate you. And for any of you guys that are still on, I'm gonna pay for 5 of your guys's mentorship with him for at least 1 hour. So if 5 of you guys are listening right now, if you guys made it all the way through, if you guys are interested, the way I'm gonna select 5 of you is I want you guys to send me a DM on the Well Squad Discord and tell me what your smart plan is. So Michael talked about having a smart plan when it comes into real estate, right? You don't just say, I want to get into real estate. Anyone can say that, right? So I don't want to hear no sad, sobby stories. I don't want to hear, that your finances are bad or whatever. I want you guys to tell me what your smart plan is to dive into real estate. And there's going to be 5 of you that I'm going to pay to get a one-on-one coaching call with Michael. Great class, man. Like I said, I appreciate you coming on, giving us your time. A lot of information, man. A lot of information, and congrats to you to having that many doors. 60 doors is no small feat by any means. You know what I mean? And
Thanks.
I see Bodie's over there in the corner ready to have some time. He's ready, man. That's cool. But no, seriously, that's no small feat at all. 60 doors that's very impressive, and I salute you for that. Keep going, man.
Thank you.
It's listening to you talk, listening to your story is very inspiring, man. You have a lot of great information and a lot of good knowledge in on this, and I just wish the best for you in your journey. And I can't wait to hear a year or 2 years down the road, because I plan on keeping in contact with you.
Definitely.
I just want to see your journey and keep living the life that you want to live. So once again, I appreciate you taking the time out of your day, coming on and dropping all these gems for our squad, and looking forward to maybe having you on again. Or like you said, you had a tax person, so definitely I'll chop it up with you outside of this. But yeah, appreciate it, man. Appreciate it.
Yeah, my pleasure. Thanks so much for everyone hanging out. Hopefully this was helpful. I appreciate you all sticking through with me till the end. And yeah, looking forward to doing this again. I appreciate you having me on.
All right, thanks. All
You're
right, you
welcome.
guys. So like I said, that was Michael. Appreciate him coming on. I'm gonna pay for 5 of your guys's mentorship with him. So like I said, send me a message on the Well Squad Discord. Tell me what your smart plan is, right? I don't want to hear sob stories. I don't want to hear your financial situation. I don't want to hear any of that. All I want to hear is what your guys' plan is, right? He talked about having a plan instead of just saying, I want to get into real estate. I want to hear numbers. I've given classes that teach you guys all these terminologies, all when it comes to the basics of real estate. So if you guys don't know, if there were some terms you guys were confused about, go back and watch the pre-recorded classes, because I covered a lot of the terminology and a lot of stuff that he's had. I go more in depth in some of those classes. So we had a good turnout. You guys asked some great questions. I've seen a lot of familiar names on here. Appreciate all of you guys that constantly show up. I appreciate all of you guys taking your time out of your day to tap into this class. And I really hope you guys learned something. I'm going to start bringing on other people. Like I said, I have mobile home people coming on for you guys. I'm going to talk to Michael to get that CPA person, the tax person on here to chop it up with you guys. I have developers coming on. I have people that do Airbnb coming on for you guys. So keep staying tuned. Like I said, we're turning things up a notch. I've covered all the basics to get you guys started. We have a lot of members who have been closing deals just from that information alone. All the classes are pre-recorded in the Well Squad University section. This class is going to be recorded. And that's all I got for you guys for the night. So if you guys have any questions for me, you guys can type them in real quick before I exit out of here. And if not, like I said, I'm looking forward to you guys sending me your messages. Tell me what your smart plan is. And I'm picking 5 of you to have a one-on-one hour phone call with Michael. It's going to be, as you guys can see, he knows what he's doing. He has over 60 units. He's invested in properties in Portugal. He's, has had his hands in many different buckets of when it comes to real estate. So I think it would be beneficial to whoever I end up selecting. And I know you guys will put it to use. So if you guys don't have any questions for me, salute. You guys have a great rest of your day.